So these are two powerful retention and volume building tools that I usually use when I have a shorter and thinner pipeline. The FHA Streamline and the VA-IRRRL, the VA interest rate reduction refinance rule. So we'll cover the highlights, specific guidelines for each, and wrap up with the study case. So take a look at the 30-year fixed rate average over the last year. We saw a peak near 7.2 in the early 2025, and as of now, we're still in the steady decline towards the 6% mark, even with the recent increase. So this downward trend is exactly why we are talking today. Anyone you put into a loan with 6.5 or higher over the last 14 months is now a prime candidate applicant for the refinance. So let's start with an FHA Streamline. This is a fixed rate, low cash out program specifically for current FHA insured mortgages. The speed comes from what you don't need: an appraisal, no income verification. We literally use 0 on the income field. We leave it blank, and no AUS findings. We only require a mortgage-only credit report. And then we go into as low as 550 credit score. For occupancy, we focus on owner-occupied primary residence all the way to investment property. Investment properties can also be eligible if the borrower moved out of a previous FHA owner-occupied home. The most critical piece is a net tangible benefit. For a fixed to fixed refinance, you must reduce the combined rate, which is the interest rate plus the mortgage MIP, at least by 0.5. And if you are reducing the term, the new rate cannot exceed the old one, and the total payment cannot increase by more than $50. So don't forget this, when you look into the checklist. So when I review the mortgage rating and the seasoning, the borrower must have made at least 6 consecutive payments, and at least 210 days must pass from the closing of the current loan. When the mortgage must have a clean 12 months of history, no 30-day late. When you're ready to submit, use a checklist here that I made for all of us to use. So always order the payoff early to determine the final loan amount, and this way we don't have to guess on the amount showing on the credit report. So when we see the payoff, you will be able to see the actual payoff showing on the credit report showing $496,000. But if you deduct the balances of escrow and the prepaid interest, the actual payoff is actually lesser than the amount you see on the credit report, which is $495,000. So when the escrow balance is not transferred, then we have to add the unpaid balance plus the principal interest so that the payoff due will be greater than $500,000. I don't want us to guess anything on this part. We have to order the payoff before we begin so that we can make sure we close in time with specific no cash out transaction. So focus on the borrower paid comp or lender paid comp for today. When we launch out the non-delegated correspondent for the FHA, this option will be applied as well. But for today, lender paid comps we have is at 2.75. Borrower paid comp is what we are doing with Capital N. You can freely pick and choose the rate you like. So let's move into the VA-IRRRL. Think of this as a VA version of a Streamline. Like FHA, there's no appraisal, no LTV requirements, and no AUS findings. Even though your mortgage amount is greater than your actual value of the home, you'll be okay. You can also do a mortgage-only credit report like the Streamline down to 550 credit score. The only unique feature is 0.5% of the VA funding fee applies unless the veteran is exempt. So on the certificate of eligibility, it will show the exempt eligibility and the amount of pension this person receives or not. So you can compare both options at the same time. VA is a little bit more flexible on the occupancy. It covers the primary, second, and investment properties, all are eligible. So FHA Streamline only had an owner-occupied and investment, but this one is VA-IRRRL is eligible for the second homes as well, provided the VA can provide proof that they previously occupied the home as a primary residence. So we can do a 1-unit properties for investment, and 2 to 4 units are allowable for the primary residences. Just remember, no leasebacks, no leaseholds, and no manufactured housing on these high balance transactions. And no commercial, no condo hotels, and no mobile homes as well. So FHA upfront MIP must be financed Same with the VA funding fee as well. We can roll in the closing costs and the funding fee. So FHA Streamline, think of, educating your borrower to bring in the payment at closing, whereas VA, we can tell people that they don't have to bring in any funds at closing. If the calculation is really tight, the cash back to borrower must be below $500 at time of closing. So VA has a strict 36 months of recoupment rule. Closing costs combine the third-party fees and the third-party fee and the funding fee and prepaid. So when we say to the clients that refinance fees are under $4,500 or $5,000, this amount does not apply the funding fee and the prepaid. Please don't make a mistake combining these two together. Your borrower may come back and say, hey, Peter, why is the loan estimate showing the closing cost of $11,000? You have to read the document with your borrower, explain to them the reasons why the funding fee and prepaid fee are excluded from the closing costs that you are selling. These are the fees that we cannot pay back using other credit or any miscellaneous options. They must be covered and recovered through the monthly savings in 3 years, which means they save about $100 a month. Maximum allowed closing costs are $3,600. That's where this is coming from. If you add the funding fee and prepaid interest, it will go and beyond that maximum threshold. So you have to build a habit of dividing these two separately. And for the for the net tangible benefit, a fixed to fixed refi must reduce the interest by at least 0.5%, like the other FHA Streamline. And PITI increases for 20% or more when the term is shortened, then you'll need a full income documentation and DTI checklist. So there will be a chance that you see 6.5% 30 years VA versus 5.125 on a 20-year fixed. But if you choose a shorter term, because the loan amount still remains the same, monthly payment will grow. Even though they move from 7.5 to 8% VA rule into 5.5, 6%. Things will happen. But I want you to understand that payment increase of 20% or more must apply for the full review. If not, we don't need the income documents and test the ability to repay. So talking about the VA case number assignment comes first, and then 210-day counting starts after funding date. So imagine that we funded the loan on month of March. First payment due of, let's say, May 1st applies. Then we have to start this 6-month rule from May and 210-day counting from the closing date, which is in March. But unlike the FHA, when we postpone a payment in the middle of these 6-month payments, then we have to restart this counting of 6 consecutive payments. Like the FHA Streamline, no income verification, no employment verification is required. We don't check for the income. We only check for the DTI, only if the new payment is greater than 20% of the previous payment. And no deferment, acceptable, allowed for this VA-IRRRL. 6 consecutive payment with a 210-day funding fee. The funding date is needed. And 1% rule on the Section A on the loan estimate applies. So unlike conventional or FHA loans where you can charge up to 3 points, VA doesn't allow you to charge more than 1% of the total cost. So you may end up charging only 0.25 or 0.3 origination fee because of the processing fee or underwriting fee. There will be a specific cap depending on the loan amount. So you make sure you run the QM report before you submit the loan. We'll run it for you as well, but be aware. Watch out for our processing team's request when you submit any VA loans in the future. When you sell the discount rate, you can charge up to 2 points. So maximum fee on the loan estimate can be lesser than 3% overall. These are the checklist, similar to what I had in the before. Basically, we're asking for the home-related documents, the mortgage insurance, mortgage, homeowners insurance, and mortgage statement, and HOA statement if it's applicable, and copy of a mortgage-only report, and copy of a note and the payment closing. It could be a final settlement closing or copy of a note, and 5th, the driver license. Then we'll be able to navigate yes or no within 5 minutes. So one thing to know with VAs, there will be a chances that we may ask for the physical inspection of the property when the property is identified as a disaster or hazard related. And we'll be able to find this when we run the flood search. So even though it comes out, don't be surprised. It's a nationwide background search tool that we use to find out. What I highly recommend for all of us is to educate the borrowers all these three options. One is to ask for the target rate or target monthly payment, and you'll be able to surprisingly give them an option, provide an option that they were asking for. And second, any transactions that you funded in the last 2 years, review all of them and see what rate they were closing with. And who knows, you may end up finding more than 10, 15 of them. Explain to them the net tangible benefit with the loan amount and the seasoning. So I don't want to talk about any closings back in September or October. If you must review the closings in 2025, the cap will be any closing started on month of June. Anything before June will be applicable for now. So these are the actual study case. Imagine that we had a loan amount at $500,000, rate at 7%. Back then, about a year ago, the MIP was at 0.7. Now we can offer the lower rate and lower MIP. Because we can hit the net tangible benefit, even with the 4,000 closing cost, this is what we can provide. The combined rate is lesser than 0.5, and the monthly payment is now reduced. Savings at $471. These are the annual saving, 5-year savings, and the break-even point is 8.5 months. So you can tell them the reasons why refinance is better. If they're occupying the home greater than this break-even point, the refinance will make sense. But if your borrower is trying to move out, sell the property, list the property and sell in the next 6 to 7 months, this refinance may not be a good option for them. Second study case, we are rolling in the funding fee of a VA. So the loan amount actually grew, but because we can offer a lower rate, greater than 50 basis point or 0.5%, and the payment reduction, and break-even point lesser than 12 months, we can also tell them the reasons why this VA makes sense again. FHA Streamline with VA, when the net tangible benefit with the break-even point is lesser than 12 months, then you can tell them this is better than the other ones. And you don't have to worry about closings. If they want it for the lower payment and think about postponing another payment, you're giving them a reasons why they need to refinance the loan with you. So if you had any closings, purchase or refinance in the last 7, 8 months, 9 months ago with 6.5% or greater, call them, tell them the reasons why this is better than the other, and you'll be able to create this chart that I was providing to you today. We don't need an income. We don't need an appraisal. So all the necessary ideas and concerns that you may go through can be solved. So if one of the applicant is losing jobs because of the urgency, because of AI, it's okay. Streamline and VA can help them. If they are trying to divorce and if one of the applicant wants to take their name out from the ownership and the loan, that's okay too. We can use the Streamline rules to separate the ownership of the property. You can use in multiple ways.